Credit score. I am sure you have heard this word numerous amount of times. What exactly is a credit score? Why is it so important? Does it affect you? And if so, how exactly does it affect you? In this video, I'm going to explain all about credit scores and credit checks and the implications they can have on your life. Welcome to Financial Desire. We are all about helping as many people as possible reach financial freedom and financial success. So before we get started, make sure you like, share and subscribe so you never miss any of our videos. Beginning with credit score. This is a number calculated by credit reference agencies and lenders which sums up all the information of your financial behavior. So how a typical lender would assess you is, when you apply for credit, each lender tries to predict your future behavior based on the way you've acted in the past, and usually this is the past 12 months, and this will help them to determine if you can keep up with repayments. To gain your credit score, a credit check is performed. So when you apply for something, a credit check will be done. It means lenders put all the information they have on you into a complicated algorithm to predict your future behavior based on your past. If you have little credit history, this is bad as the lender has no information about you. In addition, they can pay to access your information for one or more of the main 3 credit reference agencies in the UK. These are Experian, Equifax or TransUnion. Just to make you aware, TransUnion used to be called Cool Credit. There are 2 types of credit checks, a soft check and a hard check. A soft check is not visible to companies, so it has no impact on your credit score. A hard check is visible to companies and each check will lower your score. So be careful about performing too many hard checks, as it will make the companies think you are in financial trouble. The credit checks include a few things: how many applications for loans you have made recently, how much you owe, basically outstanding debts, what credit products you've had in the past, and whether you've paid them all off in time. This is the chart that credit reference agencies use, so it ranges from excellent all the way down to very poor. If you're on a poor or very poor stage, the lenders will deem you as high risk and that the possibility of you paying back any outstanding loans is very low. However, if you're in an excellent and good stage, potentially fair as well, then the chances of you paying back are very high, which means that they're more likely to accept you for any loans or mortgages that you apply for. So do not worry, as if you're in a poor or very poor stage, I will show you how to improve your credit score. To understand this, I'm going to explain how it affects you. There was a credit crunch in 2007 where there was a sudden shortage of funds for lending, leading to a decline in loans available. So now credit scoring to our financial lives has grown rapidly. To know more about this, I suggest you watch The Big Short. If you have a poor credit score, if you apply for a mortgage, you will be almost immediately rejected because they will believe you are a high risk customer. The same applies for credit cards. The credit score will determine if you'll be accepted and if you will be given a promotional rate. Moving on to loans. If you have a good credit score, this matters both for acceptance and the rates you pay. If you have a poor credit score, the chance of you being accepted is low and the rates you will pay will be ridiculously high. If you do not pay your utility bills on time, your credit score will be reduced, and this could harm chances of applying for other credits like loans, credit cards or mortgages. With mobile phone contracts, you're credit checked, and if you get rejected, you will get no contract, so you have to go on a pay-as-you-go. This is because the company is spreading the cost of the handset over your contract, so for them, it's effectively a loan. And finally, car or home insurance. If you pay monthly, the insurer is essentially loaning you the money to pay upfront, spreading the cost over 1 year and charging interest, so therefore they have to perform a credit check. In a credit checks, the lenders see your full name and date of birth, electoral roll information to confirm current address and previous addresses, all loans, credit cards and mortgage accounts that are open, their start date and loan amounts, any accounts closed in the last 6 years will be listed, current account overdrafts and how much you have, previous application searches and footprints which are visible marks on your credit file stating they've made the search, joint accounts with other people like your spouse, missed repayments and number of times it's been missed, history of debt including bankruptcy and if your identity has been used for fraud. Now, moving on to improving your credit score. There are a number of ways to do this and I'll explain. So first one, you should check with a minimum of 2 agencies once a year. You can use Equifax or Experian or TransUnion, as different lenders use different agencies. you should also register to vote, because this will show you have a stable, correct address. It's harder to get accepted for credit if you're not on a register. You should never miss or be late on any credit repayment, as it has a very bad impact on your credit score. Just once or twice could cause problems for years. Anything in the past 12 months will hurt you the most. If you have a partner or flatmate with a poor score, do not let it ruin yours. If you're financially linked, such as a joint financial product, which could be a joint mortgage, a loan, bank account, and sometimes utility bills, these joint bill accounts could mean that you are co-scored, and if they have a poor score, your score will also be affected. So I would suggest you keep your finances separate, only if you can. Use credit cards whilst being financially responsible, and make sure you pay back at the end of each month in full. If you do this for 1 year, your credit rating will go up. This in turn gives you a low credit utilization rate. Basically, if you have a credit card and the maximum is £1,000, make sure you do not spend over £300, as this will be a 30% low credit utilization rate, and this will help improve your credit score. You've probably heard the saying that closing down credit cards and not using credit cards helps. If you close down any credit card accounts, this can hurt your credit score, because when you close the credit card, you lose the card's contribution to your available credit limits. So it's actually better to order a copy of your credit score before making any changes. When you get a credit score, you should get risk factors that will describe what elements in your credit report are negatively affecting your score. If one is too many open revolving accounts, you may want to consider closing 1 or 2 credit cards. If you have a poor credit, you can get a credit card that's specifically designed for people with poor credit, and if you can't pay back the full amount, pay back the minimum amount, and remember, you have 30 days after the account due date to pay back the minimum amount. Do not withdraw cash from credit card accounts, and do not switch bank accounts within close proximity before you apply for credit, because first, it's expensive, and second of all, the lenders will think you have very poor management, so please avoid this at all costs. The next one is paying your rent or mortgage on time. I know this sounds very easy to do, but this little thing can actually help improve your credit score as long as you maintain it. Please avoid payday loans. First, they are hideously expensive, and second, some mortgage underwriters openly said they will reject anyone who has had a payday loan, as it's an example of poor money management. Next, you should reduce debt. The amount of debt you have, the lenders have access to, and if you have too much debt, it hurts your file. There's something called a debt to credit ratio, and this is how close you are to the credit limit on all your cards, so be very careful. Next, insurance. Monthly insurance payments actually affect your credit score, so try to pay up front. With the monthly payments, a hard search will be done, and this will affect your credit score as it leaves a footprint. Finally, time your application well. Any default payments that happened over 6 months ago affects your credit score significantly less than a default payment that happened just 1 month ago, so bear this in mind. Just to make you aware, you can ask credit reference agencies to remove inaccurate and late payments from your credit history. Thank you so much for watching. I really hope you enjoyed the video. Try one of my tips if you have a poor credit score, and let me know how much it improves your credit score. And if you like this video, give it a thumbs up and share it with your family and friends to help them reach financial freedom. See you next time.